A central bank raises interest rates by a quarter point. Currency traders had expected half a point. The currency falls. That seems backwards until you understand how Forex markets actually work. Central bank meetings are some of the most volatile events on the Forex calendar. The Federal Reserve, the European Central Bank, the Bank of England. When these institutions speak, currency pairs can move dozens of pips in seconds. Traders who prepare for these moments tend to fare far better than those who simply react. Here is the core mechanic. Central banks control interest rates. Higher rates make a currency more attractive to investors chasing better returns. Lower rates do the opposite. But here's what catches newer traders off guard. Forex markets are forward-looking. By the time a decision is announced, much of it is already priced in based on economic data and expectations built up over weeks. That is why a rate hike can actually send a currency lower. If traders expected a larger hike, the actual decision reads as a disappointment. Beyond the rate decision itself, pay close attention to the language. A policy statement hinting at future rate increases, what analysts call a hawkish tone, can push a currency higher almost instantly. A more cautious, or dovish, tone can do the reverse. Sometimes the words matter more than the numbers. Not all central banks carry equal weight. The Federal Reserve moves markets the most because the US dollar is the world's reserve currency. The European Central Bank drives the euro. The Bank of England influences sterling. The Bank of Japan is known for low rates and occasional sharp policy surprises. Mark the meeting dates for these institutions on your trading calendar at the start of each month. It is a simple habit that keeps you from being caught flat-footed. Preparation before a meeting matters as much as your reaction during one. Review recent inflation and employment data for the country in question. Read speeches from central bank officials. Governors often signal policy direction weeks in advance. Check interest rate futures to see what the market currently expects. If a 90% probability of a rate hold is already priced in, a surprise cut would hit hard. When it comes to actually trading these events, two approaches exist. You can position before the announcement, which carries more risk. Spreads widen, prices gap, and stop losses may not fill where you expect. Or you can wait for the dust to settle, watch for a clear directional move, and enter once the initial chaos fades. For most traders, especially those still building experience, the second approach is more forgiving. Reduce your position size around major announcements. Slippage is real during fast markets. The price you get may not be the price you expected. Waiting even a few minutes after a big release can lead to cleaner execution. If you want to practice this without real money on the line, a demo account at ZenithFX.com gives you access to live market conditions during actual central bank events. Trading carries real risk, and these meetings amplify that risk significantly. Only ever commit capital you can afford to lose.